Year 1 of investing 300 a month, the market hands you back about $118. Feels broken. Year 30, same 300 a month, same account. The market hands you back $24,500 in that year alone. Same rate, same fund. The only thing that changed is a number most people quit chasing right before it mattered. Let me earn that claim. Meet Lisa. She's 28, works in operations, takes home about $58,000 a year. After rent, groceries, her car, her phone, she's got about $400 of flex left each month. She almost spent 300 of it on a couch. Instead, she puts it into a broad market index fund and lives on the rest. No timing, no stock picking, same 300, same fund, every single month. Now let's lock the variables so the math has nowhere to hide. Same job, same salary, same 300 a month, same broad market index, same 7% real return. And that word real matters. So let's be precise about it. The S&P 500 has historically returned about 10% a year before inflation, but inflation quietly eats roughly 3% of your money's buying power every single year. Strip that out, and what's left, the growth that actually buys you more house, more groceries, more life, is about 7%. That's the number we're using all the way through, not the flashy headline 10, the honest after inflation 7, over the same 30-year window. With everything else nailed down, only one thing is allowed to change from one year to the next: the balance in the account. Hold on to that. It's the whole video. When people picture saving, they picture a straight line. 300 a month is 3,600 a year. 10 years is 36,000. 20 years is 72,000. 30 years is 108,000. Clean, predictable. That's the contribution line, the money you personally put in, adding up one steady rung at a time. Here's why that picture is so sticky and so wrong. Your brain is built to think in straight lines. You put in 300, you expect 300 worth of progress, and you imagine a ramp climbing at a steady angle forever. But compounding doesn't move in a straight line. It moves in a curve, one that starts almost flat and then bends upward faster and faster. For the first several years, that curve hugs the straight line so closely your eye can't tell them apart. They look identical. That's the trap. By the time the curve visibly tears away from the line, most people have already decided nothing is happening and walked off. So watch Lisa's first 10 years, because this is where the damage gets done. End of year 1, she's put in $3,600. The market handed her back $118. That's it. $118 for 12 straight months of discipline. It feels broken. Year 3, her whole year's market gain is around $700. Call it 60 a month, completely invisible, next to the 300 she's shoveling in herself. Year 5, she's contributed 18,000. Her balance is about 21,500, and her gain for the year is around $1,300, $100 a month. She's beating inflation, which is the entire point, but the number still feels small enough to be nothing. Year 10, she's put in 36,000 of her own paychecks. Her balance is about 52,000. The market added roughly 16,000 across an entire decade, and her market gain in year 10 alone, about $3,400, is still a hair under the 3,600 she contributed that year herself. So Lisa sits at her kitchen table and does the honest math. 10 years, 36,000 of her own money in, 16,000 to show for it. This is the exact moment most people quit, and nobody ever tells them what they're standing right on top of. Here's the mechanism underneath the flat decade, the thing almost nobody explains, because it isn't bad luck and it isn't a bad market. Compound growth doesn't run on what you put in, it runs on what's already sitting there. 7% of a small balance is a small number of dollars. 7% of 10,000 is 700. 7% of 50,000 is 3,500. 7% of 250,000 is 17,500. Same percentage, wildly different dollars. And the only thing separating them is the size of the pile it's working on. In year one, the percentage has almost nothing to grip, and it shows. But every year, the balance is a little bigger. So the gain is a little bigger. And that bigger gain gets folded back into the balance, which makes next year's gain bigger still. The growth compounds, but so does the speed of the growth. So let's find the exact line where that flip happens. Here's the whole thing on a napkin. The question is simple. How big does the balance have to get before the market's gain in a single year matches everything you put in that year yourself? Your contribution is $3,600 a year. The market pays 7%. Set them equal. Balance times 7% equals 3,600. Divide both sides by 7%, and the balance falls right out. 3,600 divided by 7% equals $51,429. That's the line. Below it, your paycheck is doing more work than the market. Above it, the market is doing more work than you ever could. And it isn't a guess or a vibe, it's one division. Your contribution divided by your return. Chant either number and the line moves, which is exactly why yours won't be the same as Lisa's. Now, here's the part that should genuinely bother you. Remember which year Lisa crosses 51,000? Year 10. The exact year she was sitting at that kitchen table, calculator out, thinking about quitting. She was standing directly on the line the very moment she most wanted to walk away from it. The people who quit at year 10 aren't quitting because the strategy failed. They're quitting one step short of the payoff because the payoff is designed to arrive right after the part that tests you. That one number gives you a map with 3 rungs on it, and every rung is the same equation, just at a different size. Rung 1 is the starter floor, any balance below the line, below 51,400. Here, your own paycheck outworks the market. It feels like saving because it basically is saving. This is where nearly every account sits for the entire first decade. Rung 2 is the crossover itself. 51,400. For the first time, the market's yearly gain equals your contribution. The account is finally pulling its own weight. Rung 3 is catch fire, the point where the market's gain is 5 times your contribution, about $257,000. At that balance, 7% alone hands you $18,000 a year, 5 times the 3,600 you put in. Your own contribution has become a rounding error. Now, something compounding does that feels almost unfair. Not every dollar Lisa invests is worth the same, not even close. A dollar she puts in during year one has 30 full years to grow. At 7%, it turns into about $8 by the finish line. A dollar she puts in during the final month has no time at all. It's still worth about a dollar when she stops. Same dollar, same fund, same person. One works for 3 decades, the other barely clocks in. Scale that up. Take the 18,000 Lisa contributes across her first 5 years. By year 30, that early money has quietly grown into about $123,000. Now take everything she contributes across her last 15 years, 54,000, 3 times as much money going in. By year 30, it's worth about 95,000. Ride that again. The 18,000 she invested early beats the 54,000 she invested late. Her first 5 years of saving out-earn her final 15 years with a third of the money. It isn't mostly about how much you put in. It's about how long each dollar gets to work. So which rung do real households actually reach? For that, we go to the Federal Reserve Survey of Consumer Finances, the most comprehensive wealth study in the country. Among households that hold a retirement account at all, the median balance under 35 is about $18,000, deep in the starter floor. 35 to 44, about 45,000. 45 to 54, about 115,000. 55 to 64, peak saving age, the last stop before retirement, about 185,000. Sit with that 35 to 44 number, $45,000. That's below the crossover line. The typical household in that bracket hasn't even reached the point where the market out earns them yet, and they've got the fewest working years left to get there. And there's a harder truth hiding behind those medians. They only count households that own a retirement account in the first place. Nearly half of American households don't. For them, there's no line to cross because there's no account doing any work at all. It's worth noting Northwestern Mutual's own research found that Americans now believe they need about $1.46 million to retire comfortably, up from 1.26 million just the year before. Against that number, a median balance in the low hundred thousands isn't a rounding error, it's a canyon. So, this isn't a willpower story. Most people are putting real money into real accounts, and the curve quits on them before they ever quit on it. Go back to Lisa at year 10, standing on the line, and let the story split cleanly in two. In one version, she quits, not dramatically, she just quietly stops adding the 300. Life gets busy, a car breaks, the contribution feels pointless after a decade of nothing. She leaves what's already there invested and moves on. In the other version, she does nothing special at all. She just keeps going. Same fund, same 300, no heroics, no extra discipline. 20 years later, Lisa, who stopped contributing, has about $210,000. And honestly, that's not bad because the 52,000 she'd already built kept compounding on its own. But Lisa, who simply kept going, has about 366,000. The gap between quietly stopping and quietly continuing is $156,000. She didn't work harder for it. She didn't earn more or pick better. She just didn't step off the line the same year she finally reached it. The second decade is where the very thing she almost quit on turns and starts paying her. Year 15, her balance clears 95,000 and the market's yearly gain, about $6,300, beats her own contribution now permanently. From here on, the market is the bigger contributor to her account every single year, and it never gives that lead back. Year 20, balance about 156,000, market gain about 10,400 a year, nearly 3 times what she puts in. Notice what just happened there. The same 300 a month that felt invisible for a decade is now the smaller number in its own account. Year 25, balance about 243,000, 1 year short of catch fire. She roughly tripled her money across that decade. Not because the market got better, it didn't. It's the same 7% it always was. But because the balance finally got big enough for that percentage to matter. Same rate, same fund, same 300 a month, bigger pile. That's the entire trick. And if early dollars do the most work, here's the most expensive decision most people never realize they're making. Not quitting waiting. Say Lisa doesn't quit at all. She just starts 1 year later. 28 becomes 29, everything else identical. That single year of delay costs her about $28,000 at the end. Sit with that arithmetic. The year she skipped was $3,600 of contributions. Skipping it cost her $28,000, almost 8 times the money, because the dollars she didn't invest that first year were the very dollars that would have had the longest runway to grow. The most expensive year of your investing life isn't the year the market crashes. It's the year you sat out and never started. Now, the part most channels skip. There are real situations where this story falls apart, and we owe you those straight. First, if you can't actually stay invested, the backloaded math doesn't help you. Need the money at year 12 for a down payment. You walk out around 67,000, the floor of the climb, not the top of it. Compounding rewards calendar time and punishes early exits. And there's no way around that fees. A 1% expense ratio does not sound like much. Over 30 years, it quietly removes about $65,000 from Lisa's ending balance. Roughly 17% of the entire thing gone to a number on a statement she probably never reads, a lower return. If real returns come in at 5% instead of 7, the crossover line rises to about 72,000 and Lisa's 30-year ending balance drops from around 366,000 to about 250,000. Same shape, gentler slope, arriving later, sometimes after the working years have already run out, and starting late. Say Lisa waits until 43, then tries to catch up by doubling to 600 a month. 15 years later, she has about 190,000, and she never reaches catch fire inside her working life to actually match the version of herself who started at 28 with just 300 a month. A 43-year-old would have to invest almost 600 a month for 22 straight years, nearly double the monthly for far longer, and still hand over about $155,000 of her own money to reach a number the early starter hit with 108,000. That's the tax on waiting. It gets paid in extra dollars because it can't be paid in the one thing she actually needed, which was time. One more honest note here. This isn't just a story about one hypothetical saver. Morningstar's own research on real investor behavior found that the average investor gives up roughly 15% of their total potential returns over a decade, not because the market failed them, but because of exactly this pattern, exiting near the bottom, re entering after the recovery, missing the exact stretch that would have carried them across their own line. Lisa's kitchen table moment isn't a hypothetical. It's what real accounts do, on average, every single year. The market does not hand you a clean 7% every year. That's an average. Some years it gives you 20%. Some years it takes 15 away. The order those good and bad years arrive in matters more than most people think, and that's a whole story of its own. But average it out across a few decades in a broad index, and the crossover is still where the tide turns. The line is real. The ride to it just isn't smooth. For the saver who starts early and stays on the line, here's where it all lands. By year 30, Lisa has contributed $108,000 of her own paychecks. Her balance is about $366,000, and her market gain in year 30 alone is about $24,500. Say that out loud. In a single year, the market handed her almost 7 times what she put in that year, more than her entire first decade of market gains combined. Year 1, the market added $118. Year 30, it added $24,500. That's more than 200 times the dollar growth from the same 7%, the same fund, the same 300 a month. The only thing that changed was the size of the balance the percentage was working on. That's what people mean when they say compounding catches fire. It isn't a metaphor, it's just what 7% does to a large balance instead of a tiny one. And it doesn't stop at year 30. Once an account clears the catch fire rung, it starts doubling roughly every decade on the strength of the market alone, with or without another dollar of her own money. So here's the trap. Stated as plainly as it can be, it isn't saving too little, it isn't picking the wrong fund. The trap is reading your first 10 years as evidence, and quitting before the curve does the part you actually signed up for compounding, doesn't lie to you. It just refuses to show you in year 5 what year 25 is going to look like. The people who win at this are not smarter than the people who quit. They aren't more disciplined. And they didn't earn more. They just stayed on the line long enough for the percentage to find some real dollars to work on. So here's the only question that matters tonight. Where is your line? Not Lisa's, yours. Your crossover depends on just two numbers, what you put in and what you expect to earn. Divide the first by the second, and that's your number. If this showed you a piece of the math you'd been missing, subscribe because we run these numbers on real decisions every week. Tell me in the comments what your own crossover number comes out to and how close you already are to it. And if you know someone sitting at their own kitchen table right now, 10 years in, wondering if any of it is working, send them this. They might be standing closer to their own line than they think.